Okay, this is the second half of the business finance test 2 review dealing with our chapter 12 problems. So this first one is the harder one because it's a larger problem. So we have Smith Dairy is considering a new dairy product and it needs to purchase a new machine for $75,000 with $8,000 in installation costs. They will depreciate it using Maker's 3-year class, 33%, 45%, 15%, and then 7%. They can sell the machine after 3 years for $34,000. The machine would require new inventory and result in new receivables and new payables for a total increase in net working capital of $5,000. They spent $2,000 investigating this project during the year. The new sales less the new cost of goods sold would be $45,000 each year. Their marginal tax rate is 35%, and their weighted average cost of capital is 9%. So calculate the initial investment. So our initial investment is going to be the $75,000 plus the $8,000 in installation costs. So that takes that up to $83,000. But then we also have to add to that, I'm going to call this the depreciable base. But then we have to add to that $83,000 the change in net working capital, because that is going to cost them money, but we don't obviously depreciate that. So there's going to be a $5,000 net increase between the receivables, the inventory offset by the payables. So then that in total is going to be $88,000 as our initial investment. The $2,000 it would just be expensed as incurred. So I'll put that in parentheses. Okay, so that's our initial investment. Then the next thing says, okay, now calculate the cash flows for year 1, 2, and 3. So year 1, we've got a net increase of net income or gross income, I guess, of $45,000 because it's sales less the cost of goods sold. So there's a $45,000 gross profit there. Now we do have to subtract out depreciation. So our depreciation, so our depreciation is going to be calculated by taking the $83,000 depreciable base times the 0.33. And that gives us 27,390. So 45,000 minus the 27,390 gives us $17,610. And that is going to be our taxable income. And then we are going to multiply that by 60%, which again is 100%, or sorry, no, 65%, because it's a 35% tax bracket. So we're going to multiply that by 0.65. And that gives us $11,446.50. So then again, I'm going to subtract that from my 17,610, and that leaves me $6,163.50. So again, if I can kind of go up here, this is my gross profit. This is my depreciation. And then that is my net of tax. If you wanted to, you could take 17,610 times 35%, which gives you $6,163.50. Wait, did I just do that? 17,610 times 0.35 gives you the 6163. And if you subtract that from the 17,610, that gives you the 11,446.5. And then that leaves you with the okay. Then if we subtract that from the, all right, then, okay, so yeah, so I'm just, the numbers are the same, but that makes sense because that part of it's the tax and part of it's the net of tax. Okay, so then now we come down and say, okay, we're going to add back our depreciation. Because that's a non-cash expense. So if we add that depreciation back, that gives us 33,553.50. All right, and let me just, okay, and then so that's going to be our first cash flow. Then we'll do the same thing for year 2, except for the depreciation is going to change. I think I did something wrong here. I think I've duplicated my, yeah, let me go back. I put my tax in there instead of the, let me take, I subtracted it from the tax amount instead of the net of tax. Okay, so the 11,446.50, then we add back the 27,390, and that gives us 38,836.50. That's correct. I'm sorry. When I was explaining the tax, I put that tax amount in there and then I picked up the wrong value. All right, so we'll do the same thing then for year 2. Try to squeeze it over here, I guess, if I can. So the $45,000 gross profit is the same because that's going to be the same for each of the years. But then now our depreciable base of 83,000 is going to be multiplied by the 45%. And that gives us 37,350 in depreciation. And then we subtract that to get to 7,650 taxable income. And then we're going to multiply that times the 0.65, which will take it net of tax. So that's $4,972.50. And then we add back our depreciation. Because it's a non-cash expense. And that leaves us with $42,322.50 for year 2. Now then year 3 is a little bit more challenging, and I apologize, I don't want that out there. Year 3, we're going to have 2 things in here. So we're going to have our salvage value at the end of year 3. And then plus we're going to have our regular year 3. So I'll do the salvage value first, so then we can just add it to the regular year 3. But at the end of year 3, if we can sell that machine for $34,000, our net book value would basically be 7%, right? That's all that's left. At the end of year 3, we're going to have depreciated all 3 of those, so we'll only have 7% left. So then that is going to be 83,000 times 0.07 gives us $5,810 as our net book value. So then if we can sell it for $34,000 and we have it on our books for 5,810, we're going to have a gain. And that is a $28,190 gain. Well, that gain is taxable. And it's going to be taxable at that 35% tax rate. So that is $9,866.50 as our tax liability. So then our salvage value is, okay, we're going to get $34,000, but we are going to owe the IRS on that gain. So we don't own the whole gain, but we own the taxes on the gain. So if we take the taxes and we subtract it from the $34,000, we will get $24,135.50 as our net proceeds. And then plus we will get a return of the net working capital. And our net working capital, again, go back up to it, was $5,000. So our total is going to be $29,133.50 as our terminal cash flow. So then if we come over here and now we do year 3, we've got same thing, $45,000 of gross profit. We've got our 3rd year of depreciation, so the $83,000 times the 0.15. And that gives us $12,450. We subtract that from our $45,000. That gives us $32,550 as our taxable income. And then we multiply that times the 0.65. And that gives us $21,157.50 after tax. And then we add back our depreciation, which is the $12,450, because it is a non-cash expense. So then $33,607.50 is our year 3 cash. But then now we have to add to it the $29,133.50, which is our terminal value, because again, we're assuming it's going to end right at the end of year 3, and we'll be able to sell it and get rid of the stuff that's left in inventory and collect on those receivables. So then that total is $62,741. Okay, so that is B. So then finally, coming into our last step, which I will slide over here, we take these and we go to our cash flow function. So our cash flow for year 0 is going to be this 88,000. Make that negative by hitting the plus or minus button and then hit enter. Then our cash flow for year 1 is going to be the 38,836.50. Enter, and that frequency is 1. Cash flow for year 2 is 42,322.50. Hit enter, and that 2 is a frequency of 1. And then the cash flow for year 3 is going to be 62,741. Enter, and that is a frequency of 1. Then we'll come over to the net present value, and the I is equal to 9. Hit enter, and then we'll compute. Just looking at it, I think it looks like it's a good project. So, all right, so 88,000, make that negative and push enter is our cash flow for year 0. 38,836.50 is our cash flow for year 1, which is a frequency of 1. 42,322.50, push enter, frequency of 1, cash flow for year 2. And then 62,741, push enter, frequency of 1. Make sure you have nothing in year 4. Come over to your net present value, make that 9, hit enter, arrow down and compute. And we have a $31,699.38 net present value. If we come over to the internal rate of return and push compute, we see it's a 26.6% return. So then obviously we would purchase that machine. So when we factor in our depreciation less our taxes, it's a very profitable investment. So then the answer would be yes. So again, I think like that's the hardest one, and it's the biggest problem that you have. So make sure that you understand that. And I wonder if I can just this page to I'll try to do that. So then that way you can kind of keep that separate if you actually want to have that worked out. Okay, so now I'm going to go ahead and clear my canvas and then go back and finish up. We have 2 more, and then these ones are smaller ones. So these 2, what they want us to do with this next one is calculate the equivalent annual annuity. And that is based on projects that have either different service lifetimes, or if they are very, very different in costs. And this one's not too bad cost-wise, but they do have a different life cycle. Let me double check that that one doesn't have anything in year 1. Let me go back over here. No, and it does. Okay, so let me scooch you those over. This is really year 1. So the key to this one is, again, this is a 3-year life cycle and this is a 5-year life cycle, and they're mutually exclusive and they're trying to compare them. So what they want us to do is compute the equivalent annual annuity. And then let me go back over real quick. And again, I think that I'm going to need to have my cost of capital. So come back over here. And when we calculate the equivalent annual annuity, what we're doing is okay, so if I take this up, I'm struggling to get it to go for me. Oh, I think because I got this on. Let's turn that off. Sorry. All right, so now I think I'll be good. Okay, so what we got to do is we got to come to our cash flow function. Cash flow for year 0 for project X. Cash flow for year 0 for project X is 100,000. Hit your plus or minus button to make that negative. Hit enter. Your cash flow for year 1 is 50,000. Hit enter. That is a frequency of 1. Your cash flow for year 2 is 75,000. Hit enter. And that is a frequency of 1. And then your cash flow for year 3, enter. That too is a frequency of 1. Then we'll come over to our net present value, make our I equal to 10, and then compute that net present value. And if I come to my calculator, and 100,000, hit the plus or minus button, make it negative, push enter, arrow down, 50,000, push enter, frequency of 1, 75,000, push enter, frequency of 1, and then a 60,000, push enter, frequency of 1. Okay, then come over to the net present value, make your I equal to 10, push enter, arrow down, and compute. And then when we compute that net present value, we get $52,516.90. Okay, so once you've calculated the net present value, then you're going to come over to use your regular time value money payments or time value money keys and then compute the payment. So for project X, it's a 3-year project, so that's our N. Our weighted average cost of capital is 10. The present value is what we just calculated. We'll enter that as a negative by hitting the plus or minus button. No, the payments is what we're computing. And then no future value. So 0 out that future value and then compute the payment. All right, so let me put this into my calculator. So 3 is the N, 10 is the IY, 52,516.90. Hit the plus or minus button to make it negative as our present value. 0 out the future value and then compute the payment. So that gives me $21,117.82. So that is my equivalent annual annuity. Then we're going to come down here and we are going to do our cash flow for project Y. So again, our cash flow function, we are in project Y, and our cash flow for year 0 is 90,000. Hit the plus or minus button to make that negative, push enter. The cash flow for year 1 is 35,000, and that frequency is for 5 years. So then we'll put in a 5 and hit enter. And then we will come to our net present value. Again, the cost of capital is going to be 10. and then we will compute that net present value. Okay, so we're going to hit our cash flow function. So 90,000, hit the plus or minus button to make it negative, push enter, arrow down. Cash flow for year 1 is 35,000, push enter, arrow down, make that frequency 5, hit enter, arrow down. And if you have anything in those future years, make sure you zero those out. Again, you can always go into the cash flow button, hit the second menu and the clear work, and it'll make everything go 0. Okay, your I is equal to 10 over in our net present value button, arrow down and compute, and we get 42,677.54. So then we're going to come over here. What am I doing? And then we're going to do the same thing. So now project Y, though, is a 5-year project. So our N is a 5. The IY is still the cost of capital, so that's 10. Our 42,677.54, hit the plus or minus button as our PV, no future value, and then compute the payment. 5 is our N, 10 is the IY, 42,677.54, hit the plus or minus button is our PV, zero out the future value, and then compute the payment. So 11,258.23 is our equivalent annual annuity. So then what we would do is we'd pick the highest one. So then what we would say is that this one here, again, is going to be our best because it has the highest annual equivalent. So then that is that. Okay, then we have one last one for chapter 12. So we come down and let me copy this out. And then come over here and we'll clear this canvas. And then we will pop it in right there. Okay, so highway services is in the last year of a project life. The equipment cost is $37,500. It's 85% depreciated. They can sell the equipment for $8,500 with a 40% tax rate. So what is the after-tax salvage value? Okay, so then now we'll come back here again, and we kind of did this in the big problem. At least we did part of it. So our after-tax salvage value is what we're trying to compute. And we want to figure out the net book value. So if it's $37,500 and it's 85% depreciated, that means it's got 15% left that's not depreciated. So 37,500 times 0.15 gives us a $5,625 net book value. I guess I already have that on there. Okay, then we compare that to our proceeds. So our proceeds are $8,500. If we have a book value of $5,625, that gives us $2,875 as a taxable gain. Then we come down and say, okay, that $2,875 times 40% is a $1,150 tax liability. So we're going to owe the IRS $1,150 in taxes if we sell that asset for $8,500. So then our after-tax proceeds, salvage value, is going to be the $8,500 minus the $1,150 that we owe the IRS. So that is $7,350, and that's our after-tax salvage value. Okay, so that is it then for test 2. Again, probably the hardest test, has the most computations, and you got to be real fluent with using that cash flow function.